Good morning. We'll wait for a few more minutes, shall we? Because there are only 6 students yet, right? How many are expected? About 10 or 12? Looks like this is the only participation today, right? Only 5 students. Yeah. Okay. Yeah, so then let's start this. Today, I'm basically going to cover a topic probably not covered much in these kind of area courses, which is the market risk management part or financial markets risk management part. I will be talking about risk in general also, so that you will get an idea of what it is. How many of you are familiar with risk management, or financial risk or market risk and stuff like that? Because that helps me to pitch at whatever level. How many of you have heard the word market risk?
So we have a little bit of understanding, but not much.
Okay. Apart from financial risk, are you familiar with other kind of risk, concentration risk and all that kind of thing? Mm-hmm. Okay. Okay. Not in detail. All right. So let's pitch it fairly basic, because my expectation for you all is, of course, not to become market risk specialists or whatever. That's a different course altogether. But here, what I want you all to understand is the concept of risk and risk management, because so concept of risk and risk management from a market. So I'll explain it from a market, financial markets risk management perspective. But it should not be limited to financial markets. Once you understand the concepts, you should be able to, broad base it and apply across all your kind of endeavors. Like for instance, how many of you have credit cards? Or for that matter, debit cards?
I think all of us have.
All of you have debit cards and credit cards, right? How many of you have taken housing loans? Huh? Yeah, everybody. How many of you have taken a lease for a vehicle or a vehicle loan? Again, most of you maybe, right? So without you realizing, or for that matter, how many of you have fixed deposits in banks? Or how many of you have current accounts in banks or savings accounts in banks? See, all these things, in doing all these things, you have knowingly or unknowingly gotten to a market risk exposure. Not only market risk exposure, you have even gotten to counterparty risk exposure, right? Now, what is the counterparty risk exposure you get into when you have a deposit in a bank? Hmm? Yes, but can a bank default? Have banks defaulted in history in the world or not? How many banks have gone bankrupt in the modern history of the world? Yeah, that is only one. But just Google and see how many banks, you will be surprised. Right, within the 2008 global, America-led financial crisis, over, I think, 100, 200 banks went bankrupt in the US. I mean, not big ones, small ones, regional ones, and so on and so forth. The big banks were basically rescued by taxpayers' money. But almost all the banks, except one or two, were facing bankruptcy during that crisis, right? So whether it was right or wrong, government decided to basically bail them out using taxpayers' money, that is you and I's money. Even in Sri Lanka, there had been quite a few instances where the government had recapitalized the state banks. Do you know that? In the early 90s, then later on, quite a few times, they had basically recapitalized the state banks. What does that mean? What does recapitalizing mean? And what does government recapitalizing their banks mean? They are using our taxpayers' money, that is you and I's money, to prop up the banks, which otherwise, if they did not have capital, what do you call that? They are bankrupt. If you don't have adequate capital, then that means you are bankrupt, right? So even in Sri Lanka, we have had these situations, right? So nothing is permanent, nothing is assured, right? That's why I wanted to bring this discussion, because many people have this notion that banks will not default. How many financial institutions have defaulted? How many non-banking financial institutions where you had deposited to get high interest rates have defaulted? So if you start thinking like that, I want you all to start thinking in those terms. Then only you will start realizing, oh God, yes, default is a real risk, right? And it matters for people to be aware of this risk and then differentiate between institutions and see who's better, who's bad, who's ugly, right? And take those calls, decisions accordingly. But unfortunately, I have noticed in my life as a professional over the last 30 odd years, both here and overseas. I mean, not so in overseas, but mostly in our country. People tend to basically take things for granted. We have a very casual approach to risk. How many of you basically continue to service your credit card, the minimum amount? How many of you know how many others who do that in Sri Lanka? The balance gets rolled over. You basically service the minimum payment or whatever they call 10% of the loan amount, right? Do you ever know that by doing it, you are getting hugely exposed to the interest rate risk? Because if rates go up with your loan, next time when your credit card bill comes, this month it will be 18% or 20% or whatever your overdraft charges or credit card facility charge interest rate. Next time it could be 36%, right? The moment the interest rates start picking up, the first thing that banks do is they jack up the credit card rate. Are you aware of that? How many of you are aware of that? Tell me. Or aren't you aware of that? Huh? Yeah, that's what I want you all to think. See, this is exactly my point. You all are exposed to it, but you don't basically understand that exposure. So this whole thing, I mean, what I am, this may not be enough because I'm trying to cover this in 2 hours, but the whole idea is for you all to basically get into that mode, start thinking in those. Now, when you deposit, you go and deposit, open a deposit. How many of you basically consider, or how many of you think through what is the kind of interest rate cycle that we are in currently? Do you ever think like that? Because if you think like that, your decisions will be very different, because by doing that, what you are practically approaching is interest rate risk. If you know that interest rates move in cycles, right? Sometimes it's low, sometimes it's high, and so forth. So during a low interest regime, what is expected in the near future is a high interest rate regime, right? Depending on whether there is inflation or whatever, right? So as economists, you need to be aware of your surroundings and understand, okay, what is the environment, economic environment that we are living in, right? So when you do that, you will realize, okay, we are at a situation where interest rates are very low. Then you will think, okay, should I basically go for a short-term deposit or a long-term deposit? What are the risks that I encounter if I go for a short-term deposit? What are the risks that I encounter if I go for a long-term deposit at these economic conditions, right? Because there is always uncertainty. Of course, you have to basically assume certain things, and wherever there is uncertainty, there is risk. That's the bottom line, right? I mean, for that matter, when you get married to a girl or boy or whatever, aren't you basically getting into an uncertain territory? That's risk, right? You are basically taking on human risk there, right? So likewise, when you start a journey, I mean, when you start your car and get it out of the garage, supposing you want to go to Jaffna or Nuwara, for instance, aren't you basically taking certain risks? You may not think about it that way. I mean, you may fall asleep, your car may break down, or So those are internal risks, right? Or it may run out of petrol, or there could be an engine trouble, or you may encounter a flat tire, or whatever. If it is run flat, of course, no problem. So run flat is a mitigating factor. But the fact remains that you are encountering certain internal risks. What about external risks? There could be a tree fallen, there could be an earth slip, there could be an errant driver who fall asleep and then come and hit you, right? So these are all risks. And are you certain about these risks? No. Are you certain about these things happening? No. So that's why so whenever there is uncertainty and when there is no assurance, then there is a certain amount of risk that you need to be aware of. And then you take appropriate mitigating controls, because you can't remove all those things. Can you ever remove the fact that there could be an errant driver who will come and hit you? A bus driver who basically runs like a maniac, who comes on the wrong side and hits you. Can you ever stop that? You can't, right? So there are certain things you can't 100% mitigate. But then, if you drive slowly, if you are very vigilant, you might be able to see that oncoming vehicle in time so that you can take some evasive action. Take your vehicle off the road or whatever, right? Or flash the lights and get the fellow to wake up or toot your horn, whatever. I don't know. So these are all things that you are trying to do to mitigate that risk or reduce the risk, but it cannot be eliminated. Same with financial risk or market risk. Risk is everywhere. Certain things are within your control, certain things are not, right? Even the ones that are within your control, you can't eliminate them 100%. For instance, your internal risk of running a car is that it can basically encounter or there could be some kind of a engine trouble, right? Now, can you basically stop that? You can service the vehicle, you can maintain it at, prime condition. Now, all what you are doing by, engaging in these activities is reducing the risk, right? But you can't eliminate it. Can you eliminate the fact that, there'll be some metal part breaking in the engine? You can't do that, right? No matter however much you try, then in that case, you'll have to basically replace your every part every month or so. Even with that, there could be factory defects, whatever. So even what I'm trying to say is even the internal risks that you think that you have control over cannot be fully eliminated. All what you can do is reduce the probability of occurrence. Again, remember the word probability of occurrence. You can't reduce the occurrence. You can reduce the probability of something happening, right? So risk is something like that. And you need to basically start thinking about all these things in that context, right? So you've got to live with risk in the environment, but as managers or as knowledgeable people, what we need to do is to be aware of these risks. Now, everybody is basically talking about, I can talk politics also. Few years back, we were talking about what? One person coming in and saving the country, and everybody basically rallied around him. Did we ever think of the risk of that person? No, we never. We went with the herd and see where we are now, right? Or for that matter, over the last whatever number of years, when we basically exercised our universal franchise, did we ever think of the risk? Perhaps not to the extent that we should have been, right? There is another way of developing these days. Everybody is talking about so and so, so and so. But have we basically looked at the weaknesses in those entities? Right? We never. We all go with the herd mentality and say, okay, no, these guys will do it. These guys, what are we doing? We'll do it. That's the key. When you say we'll do it, there is no certainty. They will do it or they might do it. There is uncertainty, right? But do we think in terms of will they fail? And if they fail, what will happen to us? No, we don't think like that. As a nation, I think we are very, very gullible to these kind of things. We are very, I don't want to use the word foolish, but we are uneducated about these things. We think that we are, super bright and all that. But when it comes to these kind of key aspects, we are very, very idiotic, I must say. Because the problem is not with the brain capacity or whatever. We have not been trained like that. Okay. So I'm giving you a kind of a presumption on this because it's an important subject, right? That's the whole idea. So we need to basically, so I'm basically combining your life's experiences, your life's encounters with the topic of risk management, right? So that's the whole idea and the concept and the context in which I want you all to understand this, right? So when it comes to financial market, there are quite a number of uncertainties in financial markets. Quite a number of uncertainties, right? And there are certain occurrences in the economy in general, in the society, that could directly or indirectly have an impact on these factors, right? So if you look at broadly, there are three main risks in financial markets. One is interest rate risk, right? Two is exchange rate risk. Then, so exchange rate risk is limited to Forex. But if you extend it beyond Forex, we can also say price risk, right? Interest rate risk also can be basically converted to price risk in the case of bonds or traded instruments, right? So if you look at price risk, what is the risk that you are basically getting exposed to in share trading? Price risk, right? That's what you are basically getting exposed to. In addition to, of course, the risk of the company performing and those things come secondary. But primarily, you are exposed to price risk. Then the third significant risk in financial market is liquidity risk, right? What is liquidity risk? We will go into those things as we move. But just to give you an example, in not so long ago, when we had the economic crisis, we are in the middle. I mean, we still are very much in the economic crisis. We have never even got out of it, even though people feel that now things are okay, right? We are not okay. We are not okay by any means, right? We are in a very fragile state. And any moment we can basically go back into that mess, right? That said, 2 years ago, things were very visible. Now things are a little opaque in terms of risks. But 2 years ago, the risks completely blew up and we were encountering them. Give me an example of a liquidity risk that we encountered 2 years ago. Some of you also may have encountered that. Give me some example. Try your luck. Don't worry. There is nothing called a wrong answer. Answer is an answer. especially in economics.
As a country, we couldn't pay any of the loans. We didn't have any money, dollars.
We didn't have any money. Very good. So there was a liquidity risk in terms of our income, because our loans would have been paid through government's income, right? Not through borrowings. Probably we should, a prudent government should be paying their loans through their income. So we had a problem there. Liquidity. There was no liquidity to pay our loans back. What else? Did we have enough? Sorry? Go ahead. Sorry?
We couldn't do any import like essentials like fuel and all that since we didn't have money.
We didn't have what money?
Dollars, basically, income.
Yes. So you have to be specific in those, right? So we as economists and as financiers, so we didn't have foreign currency, sufficient foreign currency. Okay. So we had a forex crisis. We had a forex liquidity issue, right? Who had this forex liquidity issue? You and I or the government? Because most of the private people, the wealthy people, hoarded their foreign currency liquidity in other countries or under the mattress or in the safe or wherever, right? But as a country, the central bank, as the central authority of, managing the foreign currency savings, which we call balance of payment or reserves of the country, which is the savings account of the country, ran out of liquidity. We had only some $300 million of reserves, right, at one point, or even less than that. I don't know how much we had now, I forgot. Right, we didn't have even 1 month's import cover. So that is a liquidity risk. Then in addition to these main risks, so we'll go into detail as we go, right? In addition to these risks, we also encounter risks like counterparty risk, or settlement risk, or pre-settlement risk, or concentration risk. Now, we talked about counterparty in a sense when we were talking about whether the banks or financial institutions can go bankrupt, right? Then, say suppose the settlement and pre-settlement risk comes in terms of mostly of forex, but it also comes in any trading activity, right? Now, an example closer to your life would be, you sell a vehicle, let's say, right? And this is not exactly the settlement risk as we define it, but come closer to it. You basically hand over the car, right? And the buyer basically says, I will credit your account. It's a Saturday, and let's say we don't have digital banking or whatever. Or you can't transfer, say, 10 million rupees. This is an expensive car. Or nowadays, it's not 10 million, it's a standard price. So you can't transfer 10 million through electronic banking. So he basically promises to make the settlement on Monday. If you hand over the car, right, he takes it. So you have basically performed your obligation. And come Monday, no money in the account. What is that risk? He has not settled his side. You have given your car. He has not settled his side of the transaction. Settlement risk is something like that. So whom are you taking that settlement risk on? The buyer. Right? Now, if you basically take it to Forex transactions, what do you mean by, let's say you buy $1 million against rupees, right? Do you realize that there are two sides to this transaction? Two settlements, that financial settlements that need to happen. Do you understand that? Yes or no? No. Let's say a bank wants to buy $1 million from another bank. That's the transaction. So bank A wants to buy $1 million from another bank. Let me try to get these things typed so that you can see the Word document, right? Can you see the Word document now? Okay. So there are two banks, Bank A and Bank B. Let's say Bank A wants to buy $1 million. Right? So this basically shows where it is going. So Bank A wants to buy $1 million. Now in this transaction, do you notice that there are two settlements that have to happen? What is the first settlement? Bank B giving the money to Bank A. But there is another transaction here, right? What is the other transaction that happens here? Or what is the other transfer that happens here? Obligation to settle. Now this is it's an outright purchase, not a borrowing. That's why I said buy. We want to buy $1 million, not borrow. Settle the other currency. There has to be another currency going this way also, right? What is that currency? Sri Lanka rupees, right? Because this is a local transaction that I'm talking about. Right? There has to be a LKR 300 million. That has to go this way. Right? Now, when you do the transaction, say suppose I settle my 300 million, I'm Bank A, you are Bank B. I settle my 300 million to you early in the morning. But usually I see my dollars coming in later in the day. Right? So when I basically settle my 300 million, I have not cited the $1 million coming into my US account. What am I taking? What is the risk I'm taking? I'm taking settlement risk of bank B, whether they will settle me or not. I give my side. I basically honor my obligation, but I'm not too sure whether the other party has settled me or not. Yeah. So when I say I'm not too sure or I'm not sure,
Recording in progress.
I'm not certain, that means there is a risk. What is that risk? Whether they will settle or not, or whether they will give me the dollars, or whether they will transfer the dollars or not. Right? So that risk is called settlement risk. Any questions on that? You need to understand these things very well. Otherwise, uh, no point in, then we will not be complete in our understanding. Right? So, do you understand that or not?
Understand, sir.
Okay, good. Yeah, so then we will, that is settlement risk. Okay, so let me erase this off now. How do I do that down here? Okay. All right. So that is settlement. Pre-settlement risk is we enter into a transaction. I mean, I will go to that later on. It's a little bit more complex. It's like, say, we agree to do a transaction. So we agree to do a transaction, say value date next Wednesday, right? So you agreed to give me $1 million on Wednesday, and I basically agreed to give you 300 million rupees on Wednesday, right? Now, based on this expected $1 million coming to me on Wednesday, I have gone and basically agreed to sell 2 million, say, $500,000 to someone else, right? Based on your assurance that you will basically give me 500 million on, $1 million on Wednesday, right? Now I have basically confirmed my transaction to my other party. I will sell you $500,000. Now between today and Wednesday, something happens to you and you go bankrupt. Now you are not in a position to give me the $1 million. Now I also have not given you my 300 million, because what I said was I will settle it only on Wednesday, right? So now I'm certain by Monday I know that you have gone bankrupt. So my 300 million will not go to you. That's fine. But your $1 million will also not come to me, right? But that does not devolve me from honoring the other transaction that I have entered into with my customer, where I'm basically, I have promised to sell him $500,000. Then what happens? Then quickly I have to go to another counterparty and say, please give me $1 million value Wednesday. Right? Now, in this process, between today and tomorrow, if the interest exchange rate has basically moved from 300 to 310, now instead of 300 million, I have to now pay 310 million to buy that $1 million. Now this is a risk because I have agreed with my other party to sell 500,000 based on the pricing of 300 rupees to the dollar. That's how I basically kept my margin. But now, in actual fact, I have to pay 310 rupees to the dollar. So therefore, the margin that I have assumed to have with my other transaction is becoming what? Increased or decreased? You understand what I'm trying to say? I'm trying to explain pre-settlement risk. Yes, yes, it is. It is part of counterparty risk, definitely. But the fact here is that in a counterparty risk, I will lose my entire capital also, right? So I settle. I basically give my 300 million. The other party doesn't give me the 1 million on day one, but perhaps they will give me their 1 million. Now they have not gone bankrupt, but they have perhaps they have forgotten to give me for some reason, operational fault. So that's a settlement risk. So then what happens is I'm out of money. I have given my money to you. You have not delivered your part. Maybe you will deliver it in 2 days' time, right? That's the settlement risk part that I was talking about. Now, this other one is I have an agreement to transact in 3 days' time. So I have not given my money to you. So therefore, it doesn't develop into a counterparty risk on day one itself. If I had given my money to you and then you have gone bankrupt, then it's a counterparty risk. Then it's a credit risk. It's a full default. But here what's happening is, before my money going to you, you have defaulted, or rather you have gone bankrupt. So therefore, I'm now certain that this transaction which we agreed to do on Wednesday is not going to happen. But unfortunately, now when we do transactions in financial markets, every transaction has another transaction backed up. We don't do just transactions for the sake of it, no. So based on this assurance that we came into, or agreement that we came into to transact on Wednesday, I have basically gone and entered into another transaction with a different set of counterparts based on the Wednesday's agreed transaction. Now, on Monday, up until Wednesday, if you default, I wouldn't basically consider that as a counterparty risk because I have not given or I have not paid my money to you. It becomes counterparty risk only when I make my settlement to you and you don't settle me your part. So even in a borrowing, that's the case, right? When you borrow from me, I give you money. Immediately, it becomes counterparty risk. But in Forex, there's a very specific kind of risk because until I perform my obligation to you, you don't become a counterparty risk. You are a counterparty for the transaction, but your counterparty risk comes into play only from the time I deliver my obligation to you, right? So up until Wednesday, if you go bankrupt, what I have is a pre-settlement risk because now with 300 million, I will not be able to buy the $1 million. I have to pay $310 million. So if my cost of dollars is 310 million, that means the margin that I may have kept with the other transactions, assuming that my cost was going to be 300 million, is going to erode. That risk is called pre-settlement risk. Understood? Any questions? If you have questions, please ask me, then I will explain it differently. Others? Others are very silent. Why is that? You don't understand anything that I'm talking about.
No, so this was very clear.
All right. Okay. Thank you. So that's what is settlement that the risks are. Now, they are not direct risks as far as, they are not the main risks, but those are special kinds of risks that we need to be aware of. Okay. So then concentration risk. Concentration risk could be, like, say, for instance, I do these Wednesday kind of transactions, right, with one party only. So I have bought $1 million from you, I have bought $10 million from you, and then I'm to sell 5 million euro to you, and so on and so forth. Right? So there are lots of transactions that I have done with you. Now, every transaction that I have done with you, there are certain other transactions that I have done with others. And to counter those only, I have basically come and dealt with you. Right? Then you go belly up, you go bankrupt on Monday or Tuesday. I have a whole host of other transactions that I need to now figure out how to perform. Because I know that you are not going to basically stick to your obligations, fulfill your obligations, right? So then now I'm basically like a headless chicken running all over the place trying to figure out what to do. Instead, if I had 10 different people with whom I had dealt to counter my other transactions on the other side, right? And only you go bankrupt on Monday. The others are quite stable. Then would I panic as much as I would have panicked had I done all my transactions with you? Because now I have to basically deal with only 1 or 2 transactions, not the whole host of, 100 different transactions. So what is my panic level? If I had done only with you, I would have had a very high level of panic. But since I diversified my transactions with various other people, in that situation, I don't have to panic as much. But I do have a pre-settlement risk with you. That's fine. But then, if I had pre-settlement risk and also all the transactions with you, where I basically would have got a panic attack, that kind of situation is called concentration risk. Right? So that's another issue, concentration risk. Now, coming back to our life, when we had this, let's take a situation. Let's say we focus on our tourism industry only on countries like Russia and the Middle East, and say Israel. Very interesting. And ignore all the others. So all our efforts are basically to bring these tourists from Russia, Baltic countries, Middle East, Israel type places. What is the risk that we are running then? Are we running a concentration risk or not? Because those geographies are very volatile. There are wars going on at the moment, right? So the chances of tourists coming from those countries will be, or the probability will be less, or it could be more even because they may basically jump ship and come here, get landed. But if there are natural disasters, continuation of wars, again, there is concentration risk. Do you get what I'm trying to say? So this is what concentration risk is. I mean, it exists not only in financial markets, it exists in various other plans. I mean, look at our export basket. We are predominantly garments, right? Tea, rubber, all those agricultural products, and then comes garments, and then foreign exchange comes from tourism and Middle Eastern labor force. If something happens to Middle East, that labor force, I mean, that we encountered during COVID, that whole thing got dried up, right? When there is a recession in the European markets and US markets, our garments don't perform as much as we expect. Why? Because during a recession, people don't spend that much on garments. So do we have a concentration risk or not there? One is the geographies are concentrated. The other thing is the product is also we don't have a diversified export portfolio. So if something were to happen to impact either the geography or the product itself, we suffer. So there is a high level of concentration, not only from a geographic point of view, but through different factors, geographies as well as the products. We don't have a diversified product. So that is concentration risk. And that is the reason why I'm basically talking, the reason why I'm saying this risk management discussion not only discusses about financial risk, but you can basically apply that into your other areas as well. Okay. So take it in that context. Okay, moving on. Interest rate risk. Interest rate risk, if you look at, is of two folds. One is value fluctuation and the other one is cash flow fluctuation. When there is fluctuation only, or uncertainty comes in and the rest of the works, right? What is value fluctuation? Value fluctuation is basically the volatility of the price of the product, right? Now, if you take a vehicle, right? Vehicle prices also go up and down, right? During COVID time, with this restriction, the vehicle prices really shot up. And if you think, okay, now is not the time, let me sell somewhere down the road. And the first glimpse of relaxing imports on vehicles, these prices will just fall down, right? Now, I have no control over what they are going to do. And therefore, I have no control over the prices of the vehicles, right? So that is value fluctuation. Coming back to financial instruments, you have bonds. Now you have basically, I think, learned this in the other class. Bonds are traded on price. When interest rate changes, the price changes, right? That you have, and the price versus interest rate is an inverse relationship. All those things are learned. So when interest rates move all the time, price of the bond also changes. And when the prices change, there is a value fluctuation. That value fluctuation of the bonds come through interest rates, right? So that's one of the risks. When interest rates increase, the price falls. When interest rate decreases, the price of the bond increases. right? So that value fluctuation happens, and that we have no control over that, and that's a risk that we are running. Because if we bought bonds for trading purposes, let's say, when interest rates were low, we would have paid a high price. And suddenly, in 2 months down the road, interest rates start moving up. Then what happens to the price? The price comes down. And if we have to sell now, we have bought high, we are trying to sell low, we will end up making losses. So that's the risk. Now, what is the cash flow risk in interest rates? Let's say I go for an instrument, say 5-year bond, where they pay 10% interest, right? And in bonds, you get basically coupon payments, that is periodic interest payments. And those periodic interest payments come to me at a rate of 10%. Now, this is a 5-year bond that I have locked myself into. 3 months down the road, this 5-year bond, due to some adjustment in interest rates in the economy, goes to, let's say, 13%, right? 3 months down the road. So my bond now has a maturity of 4 years and 9 months, right? If you look at a 4-year and 9 months maturity bond also, it will basically now give you, let's say, 1275. 5-year bond is at 13. 4-year, 9 months is trading at 1275, or interest rate of 1275. Now, had I waited for 3 months and bought this instrument, my interest coupon would have been 12% and 12.75%. But here, since I invested 3 months before, I'm getting only 10%. Now, don't I have a cash flow issue? Cash flow fluctuation because of this? I would have got a higher cash flow had I waited for another 3 months. So now that's a uncertainty. And also, because of interest rate movement, I have basically got a lost opportunity to earn more. That's one of the cash flows issues. The other one is the reinvestment risk. Now, in this case, it's good because the 10% that I got, I will be reinvesting at 12.75 or 13% or whatever at a higher interest rate, right? But had the interest rates fallen, my coupon reinvestments would go into lower yielding products. If the interest rates have fallen to 10%, say 8% and so forth, then the reinvestment of my interest would go into lower interest earnings. So that's the cash flow fluctuation. So then my cash flows will get impacted. Okay. Any questions there? Okay. Now, this interest rate risk, therefore, is basically a real thing. It happens to you. We'll see how it basically impacts you in your day-to-day life also. So mostly what you get in interest rate risk is an opportunity loss. The opportunity to make more money has been lost due to a decision that I have taken. That's the risk. So interest rate risk is almost always an opportunity loss. Even FX So most of these market risk discussions are based on opportunity risk. Because if you're talking of default and counterparty risk kind of thing, then it's a credit risk. Credit risk is not an opportunity risk. It's a real, it basically happens. You lose your capital. But here in interest rate risk and exchange rate risk, what happens mostly is the opportunity to maximize your gains is impaired. Right? Because at 10%, you are getting 10% interest. But you should have got 12.5% interest or 13% interest. That's the loss. Right? It's an opportunity loss. Now, tell me, when interest rates are low, locking investments for long term, is it a loss or not? It's all given here. When interest rates are low, locking investments for long term
It's a loss.
is a loss. Why? Because in time to come, when interest rates go up, I still will be earning a lower interest. Right? Then when interest rates are low, not locking your borrowings for long term is also a loss, opportunity loss. Right? Not locking long term on borrowings when the interest rates are low is also an opportunity loss, because you want to borrow at the lowest rate. You want to invest at the highest rate. Right? Now, look at your housing loan. When you're taking a housing loan, you have to be mindful of these facts. That's why I say, this, and then you convert it into a life. When you want to get a housing loans are long-term instruments. Long-term loans, say 20 years, whatever. And if you go and fix a housing loan, when the rates are at the highest, you will be losing a hell of a lot. Because when interest rates come down, you have an opportunity to borrow at a lower rate. But since you have fixed it for long term at a higher rate, you lose. So therefore, if the general interest rates in the economy are tipped to go down in the future, right, near future, and you have a cash requirement or a fund requirement for long-term purposes, what should you do? You have a long-term cash requirement, interest rates are fairly high, right? But interest rates are expected to come down in the near future. What are the options you have? This is a decision that you have to make, right? So please come and tell me what they are. They may sound very simple. Go for a short-term borrowing. One, good. There are two more. If you want to borrow long-term, what would you do? Can you go for a floating rate instead of a fixed rate? Huh? Yes. Or you can basically postpone your borrowing if the interest rates are too high. Right? No, but if you want to borrow, you can go for short-term borrowings and roll over every time the short-term loan gets matured, or you can go for a long-term borrowing, but instead of fixing the rate, you can go for a floating rate. So therefore, when rates come down, your rate comes, your final rate also comes down, right? When rates are low and you want to borrow for your leasing car, your car lease, would you fix it for the longest tenor, or will you go for a floating rate lease when the rates are low? Huh? Sorry? Go for a long term when the rates are low and fix it. Don't go for a floating rate. So these are the kind of, I'm talking mitigating factors here. Risk mitigation, but investment decisions are made based on these because of the interest. So we are talking about interest rate volatility and interest rate risk, but at the same time, we are basically discussing decision making also in this whole thing. So locking investments for long term when interest rates are moving up is a loss situation. Not locking borrowings for long term when interest rates are not locking borrowings for long term when interest rates are moving up is also a loss situation. Hold on. Then locking borrowings for long term when rates are moving down is also a loss situation. Not locking investments for long when interest rates are moving down is also a loss situation. I hope you understand what it means now. This can be explained through fixed rates versus floating rates as well. Now, we did that just a while ago. So when rates are moving up, if you borrow floating on a floating rate basis, you will encounter losses or gains. Rates are moving up, you borrow on a floating rate basis. Is it a loss situation or a profit situation?
Loss.
Loss situation. Fixed lending when rates are moving up. Is it a loss situation or a profit situation?
Profit.
Profit. And so on and so forth. So floating lending when rates are moving down is a loss situation. Fixed borrowing when rates are moving down is also a loss situation. So you need to basically understand between fixed and floating when rates are moving up or down. Okay. Because that helps you to basically apply those learnings into your own life. When you're borrowing, when you're investing, when the rates are very low and expected to move up, you don't go and fix your deposit for 5 years. That's the worst thing that you can do. Right? When the rates are at 15% and expected to come down, you don't go and book a 3-month deposit. You can book the longest possible deposit that is available in the market. Right? So likewise, that's all about, what we are talking is interest rate risk. Then interest rate risk can also come about from something called, so whether you are using a fixed rate or a floating rate, basically can lead to interest rate risk depending on the interest rate cycle the economy is on. Similarly, the floating rate, or when you are using floating rate instruments, floating rate instrument or the mechanism of a floating rate instrument is that you link your interest rate to a base or a benchmark. These are short-term benchmarks. For example, SLIBO, Sri Lanka Interbank Offer Rate. That's a overnight rate. It's a short-term benchmark. Government securities, usually they benchmark for 3 month securities or even 1 year securities if it is a very long-term instrument that you're benchmarking, right? But otherwise, 3 month government securities or prime lending rate, PLR, which is a weekly indicator, right? So now let me basically explain to you what you call basis risk. Now, whether you link it to SLIBOR, GSEC or PLR, depending on where you basically, what index you use to fix your floating rate, there is a risk. And that risk is called basis risk. Now, let's basically go try explain this. You can see this, right? The Word document?
Yes, sir.
Yeah. Now take prime lending rate, for instance. It's a short-term borrowing rate of the lowest risk customers published by CBSL, Central Bank of Sri Lanka. Right? You have the 1 week PLR and so forth, 1 month PLR and 3 month PLR and all that. Now let's basically look at these different benchmarks. You have prime lending rate. You have government securities. Let's say this is 3 months. Then you have the SLIBOR. Right? Now, these benchmarks themselves. Now tell me your experience. Do you think, or your understanding, do you think that PLR, GSEC and SLIBOR move together or they move at different rates? I'm talking their volatilities. What is your experience? Do they have the same volatilities or do they have different volatilities? No idea? Tell me whether you have an idea or no idea. That helps me.
No idea, sir.
No idea. Others? Prime lending, yes. They are all interconnected. Usually, the policy rate window set guidelines to the others. Prime lending rate is a result of, or rather, effect of prime lending rate comes from actually the policy guideline, right? When the policy window, there is a policy window. No? Now, that is different to prime lending. No? Prime lending is the commercial bank's lending rate to the prime customers. The policy window, the statutory lending rate and statutory borrowing rate are different. I have not brought them here. That is a policy guideline. So policy rate is the one which basically gives you guidance to the rest of the market interest rates. Okay. PLR, but PLR is the rate that we offer to the prime customer. GSEC is the government's borrowing rate. And FLIBOR is the interbank borrowing and lending rate in the interbank market. Between banks, when they borrow and lend, we use LIBOR. That is also a published number. GSEC is also a published number, and PLR is also a public number. Right? Now, usually, yes, these three are guided by the policy window, right? But generally, they have different volatility, right? Now, you take your calculators out, please. I mean, let's break the monotony and sleepiness a little. Switch on your mobile phone calculators. We'll do something. Let's say the volatility of PLR is 15%. Volatility of GSEC is 10%, and volatility of, this is an example, LIBOR is 5%, I have said. What does this mean? What is the most volatile and what is the least volatile according to this?
PLR is highly volatile. LIBOR is the lowest.
Lowest, exactly. Now, what does that mean? PLR would change much faster and LIBOR would be it will change but very slowly. So therefore, it's considered a more stable indicator here. Now, according to this only, this is not empirical evidence. This is, I have just put some numbers for you all to understand or for me to explain it properly, right? Now, let's say the interest rates in this are as follows. PLR is going at 9%. Government securities 3 months is going at 10%. And overnight LIBOR is going at, let's say, 8%. Okay? This is what the interest rates are. Now, if the volatilities are 15, 10, and 5%, tell me what the interest rates would be in, this is our per annum volatility, let's say, yeah? Annual volatility is 15, 10, and 5. What would be the interest rate of PLR in 1 year's time? How do you compute that? We have 9% into 15%. What is 15% of 9%? Take your calculators and do that for me, please. Huh? What is 15%? Sorry? 1.35% is the volatility. Right? So that means in 12 months, you would expect PLR to be 9 plus 1.35, which is 10.35. Right? That's in 12 months. It can be the other way around also. For this, I'm basically looking at it only from a risk perspective. Right? I will come to that other risk also later on, because opportunity is also a risk. High income is also a risk. But usually when we talk of risk, we talk of losses. Right? So that's why I basically took this the worst situation. So it could be plus or minus. You're absolutely right. Right? But for this example to explain basis risk, I'm using only the loss situation from a lending point of view. Lending is in the sense from a borrower's point of view, right? Not from an investor's point of view. So in 1 year's time, it will be 1035. Let's take this one, GSEC. It is 10% to start with, right? Now, for a moment, let's forget about these volatilities and concentrate on the starting customer rate. I think that's the best way. So let's say the floating rate lending is based on a benchmark plus a customer's margin, right? So it's interest rate plus customer's margin. So initially, if the PLR was 9% and the customer's margin was 3%, customer's rate would have been 12%, right? Forget about these ones for the time being. Then it was benchmarked at 10% GSEC benchmark, 10% plus 2% margin, it would have been 12%. Again, if it was SLIBOR and we used 8% as the SLIBOR rate and at a 4% margin, customer would have got 12%. Because it's the same customer, therefore his ending rate, we are trying to basically give him this particular rate, but it's not actually the fact. I mean, it has to be the margin, customer's margin should be the same in all these cases. But I'm trying to explain the basis risk, therefore, I'm trying to get the end rate, starting end rate table. Starting end rate meaning at the start, the final rate which the customer gets is 12%. Or at the inception, what the customer is getting is 12%. Now, the volatilities. PLR has a 15% volatility. You add the volatility into the PLR rate and you end up with a 10.35. GSEC has a 10% volatility, starting with 10%. 10% on 10% is 1%, so you end up with 11%. What is this one? Because I have seen some of these things, so let's do the calculation here. What is 5% of 8%? What is 5% of 8%? 0.4%. So your end rate here would be 8.4%. Right? Now what happens? Customer's end rate at the end of the period would be, so at the inception, regardless of what benchmark this customer used, he would have got 12% as the customer rate. Right? Now let's see what happens if he got PLR as his benchmark. PLR would have gone to 10.35. Customer's margin is 3%. He would have ended up with 13.35. Had he chose GSEC, then GSEC would have gone up to 11% based on the volatility. With a 2% margin, he would have ended up with 13%. Had he used SLIBOR, SLIBOR started with 8, which went to 8.4%, and his ending rate would have been what? 12%, right? Correct? Now see what has happened based on the benchmark, ending rate based on the benchmark. Had he gone with PLR, he would have had to pay around 13.35 towards the end of the year. Had he gone with LIBOR, he would have been paying 12.4 towards the end of the year. And GSEC, he would have been paying around 13%. You see the difference? You see the basis risk here? Had he selected PLR, it would have been the highest rate that he would have been paying. Instead, had he used SLIBOR, he would have been paying the lowest interest rate for his borrowings. So based on the base you use for floating rate, you have a risk. And that risk arises from the volatilities of each of these benchmarks. Okay, so he would have been better off using SLIBOR instead of PLR. So when you basically as corporates, or if you are a corporate member, or if you are a corporate person, treasurer or finance manager or whoever, you have to be aware of this fact. Sometimes you may not have the bargaining power to change the benchmark, but it all depends on how strong a bargaining power you have with the bank, right? The bank would always try to lend at PLR, whereas you would have been better off borrowing based on SLIBOR if you had the bargaining power, and if the volatilities were of this type, right? So you need to be aware of the volatilities of each of the benchmarks, and then see what are the margins that they apply for each of the benchmarks, and then decide on the benchmark to use. So how do you basically get the volatilities? Some of these things are published. In developed markets, volatilities are all, there are various volatilities, interest rate volatilities that they publish, because these volatilities are used for derivative pricing also, right? When you structure derivatives, if they are interest rate based derivatives, you need to basically compute the vols of the related interest rates that they use or related benchmarks they use, right? So these benchmark volatility, etc., well published in developed markets because there is a lot of liquidity in those instruments. But in Sri Lanka, we don't have many volatility benchmarks computed and published. I don't know whether CBSL does it, but otherwise, since they publish the absolute numbers, you can statistically derive using historical data, right? So that is one thing. Now, volatilities are there. Now you take the interest rates. Now, interest rates were like this. What if this rate was 8.75? What would have been this rate? Let's say all the rates begin to say. If it was 8.75 with a 5% volatility, what would be the end of year SLIBOR rate? Give me a number. If SLIBOR was 8.75, 5% volatility, what would have been the SLIBOR at the end of the year? 8.44%. 8.44%. Or is it slightly more? had to be more, no? 8.75 into 5% is correct? So 8.75 into 5.7. 0.43, right? 0.4375. So 0.4375 plus 8.75 is 9.1875, correct? 9.1875. If you add 4% margin to that, what would be the last final rate for him? 13.1875, correct? Let's say 13.19. Now see how it has changed. So the absolute rate also matters at the end of the day. This is what I'm trying to say. Now, LIBOR was at 8.75 and the rest of the ones, again, LIBOR is the lowest, GSEC is the highest, right? And in the middle, TLR in this situation. But at the end of the period, what would have happened? Had you chosen GSEC, your cost would have been 13%. LIBOR, your cost would have been 13.19. And PLR, your cost would have been 13.35. Now you see the difference. Earlier, LIBOR was the best at 8%. If interest rates or LIBOR was at 8% with 5% volatility, it still would have been the cheapest. But with LIBOR at 8.75, it's no more the cheapest at the end of the period. And you are better off using GSEC as the benchmark. Right? So therefore, what I'm trying to explain to you is, when you are looking at this is the basis risk that I'm basically explaining to you. The basis risk comes from volatility factors and also the absolute rate vis-a-vis the comparative rate structure in the market. Right? So when you are making that call, when you are looking at the basis risk, you need to look at the volatilities as well as the absolute rates and make a call and see what is the best for you. So basis risk therefore is a bit of a complicated risk that you need to basically take into account. Okay. Are you clear with this? Do you want me to explain it differently or are you okay with it? So we can move on. I'm taking a lot of time so that you understand this properly. Any questions? Silence is no, so I will move on. Okay, so that's what this is all about. And then we come to managing interest rate risk. Right? There are few tools in managing interest rate risk. Right? I think we basically alluded to some of these things in during the lecture also. Like we were saying, if the interest rates are falling, you have to go short term. If you are a borrower, if you are an investor, if the rates are coming down, then you have to lock in your investments to the longest term, and vice versa, etc., right? So there, what we were also talking about is how to mitigate risk. Okay, so managing interest rate is all about the mitigation action that we need to basically take. So if you are managing interest rate risk, there are a few tools that you can use. Of course, you can't eliminate the whole thing, but you can manage them at a palatable level. One is the duration approach. Second is the interest rate swap approach. Third would be a net interest margin approach. And also, worst comes to worst, the final is establishing a loss limit. I mean, loss limits are established for trading purposes. So if these interest rate movements are making losses for you, right? In a trading environment, they say once you reach this level, you have to liquidate the entire bloody portfolio. You can't go beyond this. Because if you hold it, you will incur more losses. Right? So those are disciplining action that we have in trading environments, trading rooms or dealing rooms. We have limit structures given to dealers or traders. When they reach those limits, they have to take certain action in order to minimize further losses. So if it is relating to interest rate movement related losses, that's a mitigation action or mitigating action to cut your losses at a particular level. So that is establishing loss limits. But let's basically look at this duration approach. What do you mean by duration approach? Duration approach is using the tenor of an instrument to minimize the adverse impact that you get or maximize the positive impact you get. That's why I said we have discussed this in the past during this lecture so far. Because what we said was if the interest rates are at the highest level in the economy, we would want to go and lock in our investments to the longest tenor, the longest duration. If we are borrowers, then at the peak of interest cycle, we would want to have the shortest borrowing. Or when we say floating rate, what we are saying is we go and engage in an interest rate which has a short-term floating benchmark. Again, you are shorting the duration of the instrument there, right? Or repricing cycle. When the interest rates are at the bottom of the cycle, if you are borrowing, you borrow to the longest fixed tenor, again, longest fixed duration. If it is investments that you are making at the draft, what you do is you go to the shortest rate duration in like 3-month deposit, 1-month deposit, and so forth, as against a 5-year, 10-year deposit, right? So what you are doing there is you are playing with the duration to manage the interest rate risk, right? So in a portfolio, you basically look at the portfolio duration, and if it is an investment portfolio, let's basically go to that. You try to lengthen the duration of the portfolio when the interest rates are at the peak. And you shorten the duration of the portfolio when the interest rates are at the lowest level. We as treasurers or we as treasury folk in banks, we do this all the time. Fund managers do this all the time, right? They look at the portfolio, they look at their portfolio and the duration of their portfolio, and either lengthen it or shorten it depending on where the interest rate cycle is, right? How do you basically change your duration of your portfolio? Let's say we call it duration management. Let's say I have a portfolio, this is a portfolio, right? Sorry. I I have 100 units. That's my portfolio. I mean, I'm not giving you a value or anything here for easy reference. And this portfolio comprises of 10-year instruments, 5-year instruments, and 2-year instruments, let's say. Right? Now, of this portfolio, if I'm 100% sure that, or if I'm quite certain, when you're in the markets, when you observe interest rates, when you plot the graphs and so forth, you know that the rate cycle then, whether it's in a recession or it's in a inflationary mode or whatever, depending on where the economy is huffing and puffing, we know what is going to happen, or we can basically assume we can forecast in a way where the interest rates are heading. Right? We may not be 100% perfect, but there is a general feeling. So depending on that feeling, that's what we call, decision making in the financial markets. So you get the feeling and then you make the appropriate call based on your understanding. So if you are quite certain that the interest rates are almost up there, but we may not be able to, pitch it at the highest point, but somewhere there. In such situation, if it is an investment that you are running, you would want to have highest amount in the longest tenor. So 90 I have put into 10 years, 7 I have put to 5 years, and 3 I have put to 2 years. Because there is this shouldn't be 100%, not 100%, let's say 90% or 95% certain. Right? Because there is another 5% probability that interest rates can still go up. So I want to benefit from that, and therefore I keep a little bit of short term. Right? So this is the portfolio mix that I would keep if I'm certain that interest rates peak, or if I'm fairly gung-ho about interest rates at the moment. And in the near future, it's going to come down. If I have a 50% probability, if I feel that it's neither here nor there, so kind of, then I would play safe. If you look at playing safe, I have put 60% on 10 years and 35 now. It can be anything, right? But majority, or rather, if I'm not decided or if I'm not too sure, then I would put 50 on short term and 50 on long term, because I need to basically generate some income also. So therefore, I would put something in the longer tenor also. But I will not be going and stuffing it with long term if I'm not sure. Right? So this would be a kind of a mix. This is not the mix, don't go by this, but you get the idea. If I'm certain that the interest rates are fairly low at the moment and they are going to go up, right? Inflation is picking up little by little. Then I would basically have a very short-term portfolio, or my duration would be very short-term. So 90 of the portfolio is in 2 years, and only 5 will be on 10 years. The rest will be about another 5 would be in 5 years. So what have I done using this? Depending on the interest cycle and expected movement of interest rates, I have changed the duration of the portfolio. Right? I have a longer duration in the first mix, and I have a very short duration on the second mix. That is called duration management. Right? Then, so through that, what I'm doing is I'm running a short, say, let's say take that one. I'm running a short-term, very short duration portfolio until the interest rates really start picking up. I'll be rolling them over in short cycles. And when the interest rates have gone to a certain level, which I'm comfortable with, I will start little by little increasing the duration. So whatever is maturing now, I will reinvest at a slightly longer duration and so forth. And when it's at peak, I will put everything into long term or majority into long term. Now, this is easy said than done. It's very, very tricky. It's very, very difficult. And that's why treasurer's job is very stressful. Okay, because we are not soothsayers, or we are not, we don't look at a crystal ball and get the information. So there is a very strong probability that our reading also can go wrong, right? But we try to minimize that error by getting more and more information about the economy, more and more information about the financial status of the country, and so on and so forth. So more the information, better our decision making would be, right? So that is duration management. Then we also I was not showing the this thing, right? Was I showing you the? Oh, yeah. So sorry about it. Now this is the duration management part that I was talking about. So this is a portfolio. You see the Word document now, right? It was a PowerPoint document, I believe. So if you look at this, yeah. When sorry about it. I mean, it happened yesterday also. Sometimes I don't change this thing. This is technical problem. I hate this online business. Anyway, so this is the portfolio that I was talking about: 100, 10-year, 5-year, 2 years. If interest rates are fairly high, I keep a long-term portfolio, longer duration portfolio, where I keep 90 of my instruments in 10 years, 3 of my instruments in 2 years, and so forth. If I'm not 100% sure of my decisions and where the interest rates are going to go, I would play safe, I said. So therefore, I put 50% into long term and closely 50% into short term. Right? I can even, depending on my comfort zone. If I'm fairly certain that interest rates are now at the lowest levels, then I would basically build up a very short-term, short duration portfolio where 90 of the instruments are in 2 years and only 5 in the 10-year horizon, right? If you look at this, third one is a very short duration portfolio. First one is a very long duration portfolio, and depending on the interest rate cycle movement, I will try to change the duration of the portfolio, right? To manage the interest rate risk. So here I said, when interest rates start picking up, I will gradually increase the duration of the portfolio because my short-term instruments will start maturing little by little, and I will go into long-term. Okay, so this is what the duration management is. Going back to the slide again, we can do swaps to manage interest rates. Interest rate swaps. What is an interest rate swap? We'll quickly finish this. What is an interest rate swap? Do you know what an interest rate swap is? Yeah, that base rate sum is the floating rate, right? It's called floating rate. Yeah. Interest rate swap, let me basically explain to you. Others know interest rate swaps, or they don't know interest rate swaps?
No, sir. No.
Okay. So interest rate swap. Okay, again, I have to go to the Word document. Interest rate swap is something like this. Suppose if you have a fixed rate borrowing I'll explain it through a borrowing, right? You have a fixed rate borrowing. Now interest rates are coming down. Since you have basically locked in, you may not be able to do much about it because a borrowing agreement or a loan agreement is a fixed instrument that cannot be changed. You are locked into that. But this derivative, that's the beauty of derivatives. This derivative of interest rate swap allows you to benefit from the situation, because if you can convert your fixed rate into a floating rate, then when interest rates start coming down, you would benefit from that interest rate movement. So in order to benefit from that interest rate movement, there is a derivative called interest rate swap. When you enter into that, or when you purchase the interest rate swap, you have to buy that in the market. You will effectively running a floating rate loan, even though your main loan is a fixed rate loan, right? So effectively, you are converting your fixed rate loan into a floating rate loan by writing or purchasing an interest rate swap on top of the fixed rate loan. So you are converting your fixed loan to a floating with an interest rate swap. You can do the reverse also. If you have a floating rate, you can convert that into a fixed rate by underwriting, or by purchasing, or by writing a interest rate swap, which converts your floating into fixed. Now let's basically see how it is done in the market. Let's say okay. Say this is the one. You can see this interest rate swap. You have gone to bank A, you are the customer, gone to bank A and borrowed 100 million on a fixed rate, let's say. Okay. So this is the transaction. You have borrowed fixed rate 100 million from bank A. Now, where will you basically pay the interest? Interest will go like this. Let me. Yeah. So your interest payment is going from customer to bank, right? At a fixed rate of 12%. Now interest rates are coming down, but you continue to pay 12% to bank A. Now, if you want to benefit from the falling interest rates, you can go and enter into a interest rate swap, either with the same bank, or because usually this interest rate is paid to the corporate bank. So you go to the treasury guys and say, okay, I want to write a interest rate swap with you all. Can you basically give me a instrument or transaction or structure, right? These derivative structures are sold by the treasury. So you can go to the same bank, or in this case, I'm using a different bank, and say, okay, I need to do a notional 100 million floating to fixed swap. That's what you say, notional 100, because your loan value is 100 here. You don't write derivatives for absolute values. It's only a notional value. So there is no cash flow exchange on the capital, right? It's only a notional on which the computations are done. So you do a fixed to floating from your side, interest rate swap with bank B. Then what happens is the customer receives from bank B a fixed rate at 12%, and customer pays the bank, let's say PLR plus 3%. Now this is the interest rate swap. Okay. So with bank A, customer has borrowed 100 million and paying a fixed rate of 12% at some frequency every month or whatever. Then customer goes to bank B and write a derivative interest rate swap, fixed to floating, notional amount 100 million, where the bank B pays fixed 12% to the customer and customer pays floating PLR plus 3% to the bank B. The interest amount is computed using the notional into fixed 12% here, notional into PLR plus 3% here, and they exchange the cash flows, or they net out the two and exchange the residue. On top of that, the customer pays fixed rate 12% on 100 million to bank A. See what has happened as an effect. Look at the fixed component. What has happened to the fixed component now? There is a payment of 12% here, and there is a receipt of 12% here. So this and this gets cancelled off. You see that? Cancelled. Again, this. You see that? Then customer effectively pays floating to bank B. That's the net effect. So his initial fixed rate loan has now become a floating rate loan after the interest rate swap. Understood? Any questions? Huh? Yes. So what happens is, see, different institutions have different needs at different times. So they have opposing views as well. So one would basically want to pay fixed, receive floating, right? Because they say people have different views. Now, generally what happens is, to sell this, there's a fee charge. So the bank basically, bank B earns a certain fee income through this. And also this bank most probably will have situations where he's paying floating to somebody else and receiving fixed. Portfolio will be something where he's paying a lot of floating to somebody and receiving fixed on the other side. So he also wants to basically hedge some of those exposures, right? So this transaction happens because, see, it will get dispersed all over the market later on. But it happens because one thing is they could have opposing views on the market movement, right? And if everyone is basically looking at one direction, then this transaction will not be there in the market. It will not be available for you to take on, You understand that? But so what we say is, if you want to basically capitalize on these kind of things, first mover advantage, you need to basically go and you have to forecast the interest rate movement fairly early and then go lock in your portfolios accordingly and benefit from the thing when it happens, right? Otherwise, what happens is this fee, when it is obvious that interest rates are going to fall, the fee charged on this particular transaction will be very high. So that this customer will not gain anything by doing the transaction. I mean, that also is a possibility. But other than that, even when everything is obvious, a bank may basically go for this because he wants to earn some fee income if he has a natural hedge on the balance sheet of the bank, where he's paying a lot of floating on the other side and receiving fixed. So then he wouldn't mind, earning a fee on 100 million. Let's say he has a 100 billion portfolio, 100 billion, where he basically 100 billion, where he basically pays floating and receives fixed. So he doesn't mind hedging part of it with, receive floating, pay fixed with this customer and earning a fee. You understand what I'm trying to say there? So these are the situations. So different banks will have different requirements from time to time. And depending on those requirements, they will basically engage in these transactions. Right. So I will stop there. From next time, I will use next lecture. I will do FX risk and quickly finish. How many lectures have you got before semester exams? I will check. I think we can. You have no idea. Okay. Right. So I will stop here. So this is what interest rate swaps are. Okay. Fine. And how you use interest rate swaps to mitigate interest rate risk. Thank you.
Thank you, sir.
Thank you, sir.